Are we witnessing signs of a financial storm on the horizon?
Today we're diving into insights from Danielle DiMartino Booth and Chris Vermeulen, essential for all investors.
And you'll get it all in just minutes, saving you time and keeping you informed.
Exactly. Get ready to explore why credit loss provisions are on the rise and what that means for your investments.
Welcome to Financial Insights in Minutes, where we decode today's top financial news.
Next, we feature an important discussion on the job market with Danielle DiMartino Booth's take on the hours work effect.
Ahoy there! Don't you feel the economic waves? We dive into the latest payrolls report and its impact.
Absolutely. Danielle DiMartino Booth reveals interesting shifts in the job market that can turn heads.
What's the core takeaway from Danielle's analysis?
Danielle emphasizes that while job numbers appear strong, many roles are low-paying, signaling stress in consumer spending and economic vitality.
What's happening with those payroll numbers?
Despite the impressive figure of 254,000 jobs added, the real story lies beneath that number. Major shifts in expectations followed.
What's this about declining work hours?
That 34.2-hour workweek signals caution. Fewer hours can lead to layoffs, reflecting instability in the labor market.
And what about job sectors?
Healthcare and education are booming, but that's not truly a sign of a healthy economy. It raises critical questions about actual job market health.
Oh, politics at play. How's that affecting the economy?
With elections looming, the uncertainty surrounding fiscal policies could shake up markets, which investors should contemplate.
What's on the horizon with the Federal Reserve?
As Jay Powell's term winds down, the implications could be vast. New members might steer us towards a more progressive economic policy.
All right, any predictions coming from this analysis?
Yes, we should watch as consumer stress rises, especially among those in low-wage jobs, potentially leading to decreased spending.
And what about market reactions to political shifts?
Market volatility will likely spike as we inch closer to the elections, driven by uncertainty over future policies.
To sum it all up, what are the main takeaways?
The data indicates critical warning signs in the job market. We need sharper insight into how payroll dynamics will play out in the future. Keep an eye out.
And hold on to your seats, folks. Next segment features insights titled, Holy Shot! Bank earnings are out showing massive loan losses.
You won't want to miss what Jeff Snider has to share next.
Anchor your sails as we dive into the turbulent waters of bank earnings and the alarming rise of credit losses.
Indeed, Jeff Snider sheds light on how rising credit loss provisions haunt banks, hinting at a stormy economic forecast.
And with iconic figures like Jamie Dimon and Warren Buffett sounding the alarm, what's the real story beneath the surface? So what's the crux of Jeff Snider's analysis? Are the banks sinking?
In simple terms, Snider argues that the surge in credit loss provisions indicates the economy is in deeper trouble than many acknowledge. He cites increasing delinquency rates and rising pessimism among consumers as critical warning signals.
Let's explore the key points raised. First up, massive credit loss provisions.
Absolutely. As Snider pointed out, provisions for loan losses have dramatically increased this year, a clear sign banks are anticipating tougher times ahead. For instance, JP Morgan's revenue dipped as they confront these unexpected challenges.
Next, what about consumer sentiment? What's going on there?
Consumer feelings are taking a hit. More Americans report anxiety about missing payments, opening a floodgate of worries about their financial future. The labor market isn't looking healthy either, leading to rising stress levels among borrowers.
And finally, let's talk defaults. What's the forecast?
A grim outlook. Snider predicts that with rising defaults, banks will face mounting pressure on their financial health. This could spiral into consumer bankruptcies, further stressing the system.
Snider's crystal ball predictions are gloomy. What's on the horizon?
He indicates worsening economic conditions could lead to a recession. With banks tightening lending, the ripple effects can be catastrophic for consumers and the broader economy.
And about the markets, how are they likely to respond?
Expect continued stock market volatility as investors react to the grim economic forecasts. Increased bank losses will likely lead to knee-jerk reactions, complicating the investment landscape.
So to wrap this stormy summary up, what's our big takeaway?
The evidence from bank earnings paints a dire picture. Credit losses are rising, consumer sentiment is faltering, and the sails of the economy look ready for a turbulent journey ahead. It's time for some serious reflection on financial policies and consumer strategies.
But hold on to your life vests. Up next, we have an insightful look from Chris Vermeulen on year-end market forecast. What the trend says will happen next. Chris Vermeulen.
You won't want to miss the surprises he has in store.
Our next insightful summary dives into the year-end market forecast. Are we riding high or about to crash?
Chris Vermeulen shares his long-term bearish outlook despite recent market highs. Seems like a paradox.
The man's got a knack for forecasting. What insights are hiding behind those bullish market trends? What's the core message from Chris? Should we be celebrating those highs, or is something brewing?
The central thesis is clear. While markets are performing well now, significant declines up to 50% could be looming as early as next year. He emphasizes being strategically prepared for such shifts.
What's happening now in the market?
The markets are booming. Goldman Sachs has upped their S&P 500 target to over 6,000 points, a modest increase, but indicative of overall positive momentum.
And what about that long-term view? Are we really bracing for a storm?
Absolutely. Chris suggests a potential market drop of 20 to 50% next year, highlighting the importance of strategies to safeguard investments.
What's the analytic angle Chris is employing?
He's delving into technical analysis, revealing patterns that suggest upcoming market volatility amid economic uncertainty, a sharp contrast to the current celebration of highs.
So, what should we steel ourselves for in the coming year?
Chris predicts a significant correction in 2024, anticipating a potential black swan event to catalyze this downturn.
Any advice for investors on how to prepare for this?
Chris encourages a reevaluation of current positions, steering towards more defensive sectors to weather the storm.
To weave this all together, what's the overarching takeaway?
Chris reinforces that strategic positioning is crucial. Investors must be flexible and ready to adapt to various market scenarios.
But don't drift away just yet. What's coming next?
Next up, we'll uncover more insights, featuring Tom on Insiders Are Doing Something Interesting, S500 Bitcoin. Expect revelations.
Navigating the turbulent seas of the market. What's driving insider trading activity lately?
It's fascinating. Multiple data points indicate insiders are making some intriguing plays. It has traders raising eyebrows and potentially reshaping strategies.
A ripple effect, if you will. So what are the latest indicators that we need to be aware of? What's the essence of the findings on insider trading and market movements?
Tom points out that the recent trend shows corporate insiders buying stocks at the lowest rate in a while, sparking worries of a slowing bull market while hinting at potential sector rotations.
Wow, that volatility among single stocks is something else. What's contributing to this spike?
Tom mentions that unlike previous earnings seasons, the current one could see significant moves after earnings reports, suggesting that traders must be cautious yet attentive to recent shifts.
Banks seem to be busting out of their shells. What are the earnings hinting at?
Indeed, Goldman Sachs reported impressive figures with an earnings per share of $8.40, up 54% year-on-year, highlighting their resilience during shifting market dynamics.
And what's happening in the crypto world?
The crypto space is buzzing. There have been notable trading volume spikes, especially in Bitcoin, which suggests increasing institutional interest.
Looking into our crystal ball, what do we expect on the horizon?
Tom anticipates sector rotation, suggesting that as larger caps rally, smaller caps may finally see their moment to shine, creating a more dynamic market landscape.
And how about future volatility?
Buckle up. With each earnings report expected to bring wild price swings, traders must stay alert for opportunities amid uncertainty.
So what's the bottom line here?
In summary, heightened insider activity paired with a volatile market suggests both caution and opportunity. Investors might want to reevaluate their strategies for the forthcoming earnings cycle.
But wait, there's more to uncover. Up next, we dive into whether the Fed has jumped the shark by cutting rates too early with Chris Whalen.
Stay tuned for crucial insights that could redefine your market strategies.
Ahoy! Our next insightful summary dives into whether the Fed jumped the shark by cutting rates too early.
Exactly. Chris Whalen of Whalen Global Advisors argues that the Fed's recent moves could lead to a turbulent economic sea ahead.
What insights does Chris bring from his recent trip to Washington? Let's set sail into the details. So what's the crux of Chris Whalen's argument?
Whalen believes the Fed acted too quickly, risking inflation issues that could compound over time. He foresees mortgage rates possibly rising again, threatening the housing market.
Let's break down some key points, starting with the dollar and its global implications. What's the word on the street?
Whalen highlights that the Fed's focus may have shifted more towards global economic stability than U.S. domestic policies, suggesting that stagnation overseas could influence U.S. decisions.
And how about mortgage rates? What does Chris predict?
Whalen warns that rising mortgage rates may inhibit home buying, pushing affordability further out of reach for many, which is a critical concern moving forward.
Switching gears, how do politics play into this economic picture?
Whalen emphasizes that political motivations often pressure the Fed to prioritize short-term fixes rather than long-term economic health.
What does Chris foresee in the future regarding inflation?
He predicts inflation could rear its head again, influenced by international events and domestic pressures, leading to further volatility.
Any thoughts on how these predictions might shape the housing market?
Whalen warns of market instability as the Fed's moves continue to ripple through the economy. Investors should be vigilant.
In summary, what are the main takeaways from Chris Whalen's insights?
Whalen emphasizes the urgency for strategic financial policies to tackle looming credit challenges and inflation risks. Those looking to weather the storm must pay close attention.
And what about the Fed? Any advice for them?
Whalen urges the Fed to rethink their balance sheet management, promoting transparency and consistent methodologies for improved financial stability.
Anchors away. Don't miss the next segment featuring economist Steve Hanke. He'll be discussing what the money supply signals about the economy.
You won't want to miss Hanke's insights, so stay tuned for what's to come.
Riding the waves of economics, let's dive deep. What's the real story behind the money supply and its effect on inflation?
In a nutshell, Steve Hanke emphasizes that understanding past money supply changes is crucial for predicting economic activity and inflation.
The age-old tale of past influences shaping our future. What are Hanke's key insights? So, what's the main essence of Hanke's observations?
He contends that the money supply's growth directly impacts inflation and economic performance, but these effects take time to manifest.
First stop, China. What's the buzz there?
China is witnessing a slowdown with inflation dipping, indicating weak demand, and any potential growth targets may fall short.
Now, about the U.S. situation, what's the impact of the contraction?
The contraction is quite rare and historically precedes recessions, raising serious concerns for the near future.
And over in Europe?
It's worse than the U.S. Stagnating growth and consequential repercussions from sanctions against Russia add to the economic gloom.
What should investors be wary of?
Geopolitical tensions and unrealistic market evaluations could spell trouble. Investors need to stay vigilant.
Let's peer into Hanke's crystal ball. What does the future hold?
He predicts that continuous economic weakness and instability will likely lead the U.S. into a recession next year.
What about China's recovery plans?
Hanke warns that without focusing on revitalizing the money supply, any plans will be futile.
Summarizing all this, what's the takeaway for our audience?
Keep an eye on the money supply. It's a significant predictor of economic activity and inflation trends. With the future uncertain, vigilance is key.
If you're feeling enlightened by these insights, consider subscribing.
Your support fuels content that keeps you ahead of the curve.
What a riveting discussion we've had. We've clearly highlighted some serious concerns facing the economy.
Absolutely. Danielle DiMartino Booth points out a troubling trend in the job market with her analysis of the hours work effect.
And Jeff Snider warns us about rising credit losses that could spell trouble for our banking sector.
Chris Vermeulen even chimed in with potential market corrections, something investors should keep an eye on, especially in tech.
Not to mention, the differing opinions on the Federal Reserve's impact between Steve Hanke and Booth add another layer of complexity.
Exactly, it's vital for our viewers to digest these insights as they develop their investment strategies going forward.
Thanks for joining us today. If you found these insights valuable, please like and subscribe to our channel.
And don't forget to watch our other videos to stay informed on these fast-changing markets.